In the morning, a lot of our speakers have already shared on different products and also how the markets are moving. So maybe this panel discussion will do something a little bit different. We'll be asking what investment director, a senior portfolio manager, and a manager of our FSM1 investment advisory team, what do they invest in? Okay, so maybe we can start with Kenny. What was the first ETF you personally bought? When did you start investing in that ETF, and how did it fare, or how is it faring right now?
Yeah, I have been in the fund management industry for more than 30 years, so hopefully I don't look my age. I'm the oldest here. I actually started in the industry back in 1991. At that time, I think if I were to turn back the clock, I actually experienced quite a number of crises in the past. So the first ETF, because I was a fund manager, so I always think that I can pick stock myself pretty well. But then when ETF started to come up, I think there's a very interesting low-cost proposition, especially for those markets that I don't know. So back in 2008, during the global financial crisis, I actually invested in iShares, the US, MSCI US ETF. So that was the first ETF that I invested in. I actually exited prior to joining iFAST at 2019. So I make a return of about just 150%. And if I were to hold on till now, it would have returned like more than 200%.
Well, that's very impressive returns, actually. Okay, what about Weiren?
The first ETF that I ever bought for my portfolio was actually the STI ETF. So I think when I first started on my investment journey, I like to do stock picking. But one thing that I realized was some of the stocks that I picked didn't really quite outperform the STI ETF. So I figured that the best way to go about doing your investment is if you can't beat them, you join them. So that was why I bought the STI ETF. How has it performed? To be honest, I think it has not performed very well because the fact is, over the past, I think 10 years, if you compare the performance of S&P 500 versus the STI ETF, I think Singapore has been trashed by US equities. So along the way, I realized that, and I figured that perhaps having a bit more exposure outside of Singapore was a prudent thing to do. I was also under the influence of Warren Buffett because he said, just having exposure to a low-cost S&P 500 index fund, that's more than enough for a portfolio. So I decided to go into US. So the second ETF that I bought was actually the S&P 500 ETF.
Yeah, and what about Katherine?
Personally, myself, because I do have a portfolio of mostly unit trust investment initially, so it's already globally diversified and some regional unit trust available that's actively managed. But for myself, I started investing probably about 2-3 years ago during the pandemic period because I actually like some of these. The earlier presentation, Tjan, our equity analyst, has actually presented about the semiconductor ETF. So that was the one that I've invested in because I like some of the names that are in the ETF like TSMC, Nvidia, Intel, and so on. But it's very expensive to keep buying individual counters, and it doesn't make economical sense to buy like 10 of them because I'll be paying so much of the transaction fees. So hence I taken up the ETF that Tjan actually recommended, and over the course of the last couple of years, you have definitely seen better days, but it's still currently, happy to say, it's still in the money. Yeah, but definitely here for the long term. Yeah.
That's very interesting sharing from our panelists. So on our panel today, right, our three panelists are actually at different life stages. So Kenny is nearing retirement. Weiren, he's a father of 2, and Katherine, she got married last year. So maybe Kenny, as someone who is nearing retirement, right, does the recent market turmoil actually worry you?
Yeah, maybe it's also perhaps my exposure to the industry as a fund manager. So actually market the turmoil doesn't actually worry me. I think the important thing to note is that as long as you know what is the risk that you can take, and also have a proper cash flow planning. To me, every market turmoil actually present you a great opportunity to grow your wealth. And that's how I did it over the past 30 years.
And for Weiren, as a father of two, what are your investment objectives like?
In terms of my investment objectives, I think I've got two. One is personal, which is to invest for my own retirement, to ensure that my portfolio assets will be able to last me through my retirement days. I think that's my primary investment objective. The secondary investment objective, it relates to my kids. So what I've been doing for them is to set aside money for them on a monthly basis, in a pot of money to be invested in longer term equity ideas. And the intention of this pot of money really is to help them out with their future, high ticket, big ticket expenses like your university, wedding, and hopefully there's some money left behind for their first property purchase as well.
Yes, I think that's what most parents are doing. And for Katherine, as a newlywed, what are the factors that would shape your investment objectives?
Actually, for myself, because I got married during the COVID times, I was quite lucky that I didn't have to have a very elaborated wedding. So to be honest, I did not spend a lot. So what I actually mainly spend on is on my renovation. And I think in Singapore, if you all have ever done renovation, it's so expensive, be it all the carpentries and all the different tiles and so on. So a bulk of my money actually set aside for that. And I've took out a couple of those renovation loans as well as those installment plans. So I think this shapes my investment objective, as in I do want to grow my wealth, but at the same time I do not have a very huge large investment lump sum to start investing with. So personally, what I did is, because currently I'm still serving these loans, which was quite fortunate that I locked in at a very low rates. At this time, I'm actually just doing a regular savings plan into like those ETFs and some unit trust investments as well for a very long term, because all these are very bite-sized investments and it's more digestible for my finances.
Okay, thank you. And I'm sure everyone here, some of you, or even most of you, have access to social media. And social media these days, there are a lot of self-proclaimed, investment influencers, investment gurus, all that, and their clickbait videos, all that, right? So maybe I can just ask Kenny, how do you filter like which ones are genuine? Have you ever come across any of them?
Yeah, I just have to be very honest with everyone. I'm not a big fan of social media. So I think there's a lot of noises out there. So I started in the industry like 30 years ago, and when I conduct research, I go and take an annual report and I read it, the Warren Buffett way, right? You have to read the annual report and do your own homework. So in a way, I think social media give you a lot of information with regards to the different investment opportunities out there. But again, they also provide you a lot of what I call trap that, potentially if you don't do your homework, you can get hurt. So what I would suggest to everyone here is that if you want to invest, your hard-earned money, you better do your homework. Let's say if you're too busy and you're not able to do a lot of what we call due diligence, then I think one of the easiest way is to invest in a broad, diversified asset class like an ETF. So I think that, first of all, will diversify your risk significantly, and secondly, get you the exposure that you want to get.
Okay, Weiren, do you have any response?
I feel that, Kenny doesn't really use social media. Actually, neither do I. I don't have an Instagram account, but I do go onto Facebook. But I think one way to really tell whether some of these, influencers, whether they're giving good advice or not, is to see whether they're giving dubious advice. So if you see people telling you that, hey, I've got this this investment tip that can give you guaranteed 10% returns on a yearly basis, you know something is wrong. Okay, nothing is guaranteed in the world of investments. Or if they guarantee you a certain level of gains in a certain period of time, I think, yeah, these are red flags that we look out for. But if the person is just voicing out a view, which pretty much anyone can do in the world of social media, I think no pain hearing them out, see what they have to say about a particular company or a particular market. If you would like to do homework on the influencer himself, I think Sidley provides quite good crowdsourced advice on some of these influencers. So you can check out Sidley reviews as well. But ultimately, I concur with Kenny that ultimately, I think it is your responsibility to decide what investments you want to buy for your own portfolio.
Thank you, Weiren. And Katherine, I'm sure there are a lot of clients who send you these videos and ask for your advice, right? Like, how do you usually respond?
Yes, actually, yeah, some clients would email me and ask me like, is this legit? But I do concur with both of them that if it's too good to be true, it is definitely too good to be true. And also, definitely doing your own homework before you invest is very important. But I do think like some tips, like for instance, I think when T-bills the yield was across 4%, I think there was a lot of these forums and these individuals that recommended investing in T-bills using your CPF monies. Then I thought, mathematically, it actually works out and it does actually make sense. So I do think that on social media, yes, there could be very true, legit advice, and sometimes it could just be too good to be true. And I think most of the time it's best to dwell deeper in it and see what is the thing that they are trying to sell and what's the motive behind all these investors or these influencers trying to sell you these ideas for. Yeah.
Okay, thank you. And I think Kenny and Weiren, both of you have children, right? So if one of your child, like they saw one of these videos and they came up to you, what would you tell them? Weiren first.
I think if my child comes up to me and show me one of those influencer videos, I think my first reaction would be to ask them what they think about it, whether they agree with it. So I think ultimately, after watching all these videos, you need to have a view on that particular instrument that the influencer is talking about. If they are talking about like Singapore banks, for example, and painting it in a negative light, I will ask my child whether he agrees with the analysis given by the influencer, if not why. So at the end of this process, I hopefully my child will be able to come to a conclusion of why he is positive or negative on Singapore banks. Because when market conditions are tough, one of the ways to ensure that you do not do knee-jerk reactions is to remember why you buy this investment in the first place. So if you can't remember, why you even buy this stock in the first place, it's very easy for you to be overcome by your own emotions. When there is a sell-off, you will definitely panic and you will sell off all your portfolio. So I think having that conclusion, whether he agrees with that analysis, I think that's important.
Okay, that's food for thought. And for Kenny, what's your opinion?
Yeah, I will always tell them there's no free lunch. I think when something is too good to be true, always treat it with skepticism. I think ultimately, a lot of news flow out there will tell you this is a great investment opportunity. I think in the crypto space, there has been a lot of this. I'm not talking about the mainstream Bitcoin and all the others, but even some of the very, very speculative, crypto. So one of the way I taught my, my university going daughter. So she heard from a friend that her friend made like $1,000-$2,000 over a space of less than a week. Then what I did to her is that, do you believe that money is so easy to be earned with such little investment capital? So what I did was I actually opened a crypto account for her. And I gave her about $100 to invest in. And over time, you monitor, what is your kind of investment. And ultimately, she learned the investment experience and it turned out to be, of course, a bad one. Then she'll realize that actually, money is not so easy to be made, right? And easily you hear from rumors, hearsay. I think that's the best way to put your money into the drain.
Thank you, Kenny, for the wisdom. And okay, I think a lot of our clients are worried about a recession in 2023. So, and it seems imminent, like because of a lot of factors pointing to it. So, how do you think investors can leverage on ETFs to weather the storm? Maybe we can start with Katherine first.
Yeah, because I mean, recession is a big thing because a lot of portfolios will definitely perform poorly during this time. So, I mean, other than choosing the right ETF or the right investment tool, I think it's also important to boil down to individuals' risk profile and also like what Weiren said, to understand why do you even invest in the product in the first place. So, I think like probably right now, investing in high quality companies will definitely be a bit more resilient in the portfolio, so that there's lesser drawdowns. I mean, these equity markets do not defy gravity. So when there's a market risk, everything comes down. Probably earnings do revise and performance of the portfolio does perform poorly as well. But I think markets are always forward-looking. So probably, you know, when recession is coming, markets has already priced this and is also reflected in the equity markets as well. So I think other than investing in high-quality companies, we also advise investors to keep some allocation into fixed income assets like very high quality bonds as well. All this helps to reduce the portfolio volatility and let them, sleep better also lah. Yeah.
And Weiren?
I think I've highlighted in my presentation just now. I think just because a recession is coming, it doesn't always necessarily mean that investments, your equities, it will necessarily do badly. So I think the key thing is to be number one, selective, and number two, have a diversified portfolio, and that is where ETFs comes in because they are low cost and they are also diversified investment vehicles for you. So I think having that diversified portfolio can be a very good thing, a very good anchor for your portfolio as we go into more volatile and more uncertain times in the year ahead.
And Kenny?
Yeah, actually, to me, trying to time the market is always a very challenging thing. And usually you want to sell at the worst possible time and you want to buy at the worst possible time. So, and I think the mindset of a lot of investors, as far as I know, me included, is that we know how to control and we know how to decide what we should be doing. So for individual stocks, let's say, for example, if something nasty happened, let's say, for example, during the COVID and everybody was worried about Disney, nobody's visiting Disneyland, and then, you just, when you're holding a Disney stock, although it's still a blue chip stock, you get very anxious. So when you see the stock price tumbling, you tend to react. And that could be the worst possible time for you to exit the stock. But on the other hand, if you were to look at ETF, because there's so many positions inside the ETF and it's diversified, sometimes you don't even know what's inside the ETF, right? So you tend to take, I think, a more casual view in terms of holding on, when the times are bad. And then you also keep on to it when times are good because, you can't actually decide which is the best stock within the ETF. It's just a good ETF, for example. And then you tend to kind of like, keep holding on to the position, and if you're adding on to the position so I think over a longer term, you may potentially get a better risk reward from investing in ETFs.
Okay, thank you. And I think there are definitely a lot of clients who are concerned about recession. So maybe Katherine can share like what are the concerns that the clients usually have.
Yeah, some clients do have like, for instance, when markets are better, they invested in some high yield companies. So definitely the risk is a lot higher compared to a portfolio of ETF that invest in a high yield bonds. So there's more homework to be done, especially when recession is coming. If you're holding individual counters or bonds or what, you might want to look carefully into their balance sheet and to see how is their businesses and so on are being affected, and do they have enough liquidity? Because I think cash is king, especially in this kind of high interest rates period. Yeah.
Okay, thank you. And I think one of the last few questions that we have, like for investors who wish to start investing but have yet to, do you think the dollar cost averaging into an ETF is a good way to start? Kenny can start first.
Yeah, I think for retail investors, dollar cost averaging is definitely a good strategy to have in mind. Because, as I mentioned earlier, trying to time the market is always very, very challenging. Yeah? You won't buy when the market is having a sell-off, and you won't, sell when the market is, doing very well. So a dollar cost averaging approach, I think, is a very disciplined and very systematic way to actually deploy your savings and your wealth into the asset class that, you would like to invest in.
For Weiren?
I think it's good. It's a good way for investors to invest. But I won't repeat what Kenny has said, but just add on to say that I think a lot of people, when it comes to ETFs, they don't invest in it because many of them, they don't really understand how it works. So RSP would be a good starting point for you because with just $50, you can actually get started with RSP. So the maximum amount of money that you can lose in this ETF is just $50. So while you do your RSP, you can actually do your homework in the background to decide which are the ETFs that you really want to invest in, which are the ETFs that you are willing to put a lump sum in, while still having that exposure to markets using RSPs.
Yeah, I think that's a very good way to make use of the RSP, especially of the 0% processing fee FSM1 is offering. And for Katherine, what do you think for?
I do think that, for investors who have not yet started investing, I think it's very daunting to buy individual stocks, especially when the stock prices moves up and down quite wildly, especially for those tech stocks or other names that you might see of. Like sometimes it moves 5-10% in a day. So I think to get your toes wet and to dip your, to spread out your investments, definitely a ETF would help to diversify, and also dollar cost average as you go along, because you never know when the bottom is. Yeah, but you can definitely average in and lower your cost and accumulate more units when prices are lower.
Okay, thank you. Okay, last question for all our panelists. What is an ETF on your watch list right now, and what is interesting about it? You can start with Kenny.
Yeah, I wouldn't say I have just one ETF on my watch list because, like for example, depending on your investment objective in the current environment, like for example, if your objective is to preserve capital and maybe get a slightly better yield than putting your money in the bank, then I think the likes of like the Nikko Sing Dollar investment grade bond, those that offer you around 3 to 4 or even slightly higher yield would be good from a capital preservation angle, especially if you sincerely believe that recession is definitely coming and it's going to be a bad one. The other way I look at it is that you should also watch some of the equity ETF. I think earlier I have seen Tjan presented on the VanEck semiconductor ETF. I mean, those are things that won't change. It will be like a structural trend. So I think when again, if you think that the current price is low enough, you can start accumulating a position. If it goes down more because the recession actually is getting worse, then you can accumulate more. And even like a very broad base S&P 500, if the market correct like 20%, I'm not suggesting it will, then I think that would be a way of you looking at some of those broader exposure equity ETF. So I think that should be the one that you should be mindful of.
Okay, Weiren?
I have 2 ETFs. I'm doing RSPs for 2 ETFs at this moment. These 2 ETFs give me exposure to some of these mega trends. One of which is semicons. The other one is actually a metals ETF. So to me, I think mega trends, as what Kenny has mentioned, I think it is something that transcends your short-term economic conditions, your interest rate cycles. So it doesn't matter where interest rates are in the future. It doesn't matter whether inflation is stubborn or not. I think a lot of these trends will be set in motion for the next few decades. So I think semiconductors is one ETF that I have on RSP because I believe in a long-term case for semiconductors and the increasing digitalization of the global economy. The second one is the metals ETF by VanEck. If you're interested, you can go to our ETF focus list. The ticker code is REMX. The reason why I buy this ETF is because I believe in the green transition. But sometimes, if you think back about the gold rush, okay, during the gold rush, instead of buying gold, there are many other things you can buy. Okay, you can buy a business that sells the shovels and picks. You can also buy businesses like Levi Strauss that sold jeans to all these miners during the gold rush, and all of these businesses were extremely profitable. So if the current green energy transition is the gold rush, then the picks and shovels in this case will be all these metals, all these raw materials that will go into the construction of your wind turbines, your EVs, and also your solar panels. And some of these green energy technologies, honestly, they are still not proven yet. They may not work out in the future. So I think the best bet, if you want to look for an ETF that plays on the green energy transition, go for a metals ETF instead.
Okay, thank you, Weiren. And for Katherine?
Personally, myself, I also have the VanEck ETF on my watch list, but not the VanEck Semicon or the metals one, but it's the VanEck Morningstar White Mode ETF. So why I like this ETF and I find it very interesting is because this white mode investment concept actually originated from Warren Buffett. He likes to buy companies at a good valuation and also has strong moats around their businesses so that it can protect its profits from competition. And these companies do show, I think Morningstar, the research equity team, do classify them into 5 different sources of economic moat. So one of them includes high switching costs. Second one is like intangible assets like patents, IPs, and also brand equity and so on. The third one is cost advantage, whereby the companies have low costs in generating their products and they get very good high margins from it. And fourth is the network effect. So like the more users they have, it benefits their current users as well as the new users. Yeah, so like services like Google, Visa, those are companies with wide economic moat. And the last one is the efficient scale. So that means in a industry that generally do not have a lot of competition and they are naturally a monopoly there. So there's a very high deterrence for new competitors to join in due to high capital startup costs and so on. So the Morningstar Equity research team will classify based on these 5 economic mode, and then on top of this, they look at companies that are trading below their fair estimate value. So like example, like maybe they target the price as 100, but currently the stock is actually trading at 70, for instance. So they will include these stocks inside their index itself. So this ETF actually tracks this Morningstar White Mode Focus Index. So the stock code goes by MOAT. So this is like the castle with the moat with deep trenches around it. Yes, and they have the global international version of this ETF with the similar concept of choosing economic mode. It's called the VanEck Vector International Mode ETF. So that goes by the ticker MOTI. So I just thought this too is quite interesting.
Okay, thank you, Katherine. So we've come to the end of our panel discussion. I hope you have taken note of the ETFs they have shared. Okay, back to you, MC.